Hi, good afternoon, everyone. First off, we just want to thank the judges for coming out today. We really appreciate it. We would also like to thank everyone for us being here. It truly is an honor. My name is Josh Cohen, and the rest of the Rutgers Business School is comprised of Dimitri Malinsky, Andre Mendoza, Russell Miller, and Anil Bhatia. I'm going to run through some of the highlights of our presentation, and then I'm going to hand it over to Dimitri. He's going to speak about the company overview. Today, we're going to be presenting our research on New Jersey Resources. It is a New Jersey-based utilities company and a local distributor of natural gas. Our research shows that New Jersey Resources is overvalued. It currently closed today, just about 5 minutes ago, at $42.75 a share. Our valuation model puts it at $36 a share, representing a 16% discount from where it's currently trading. As we continue to discuss New Jersey Resources, it's important for everyone to remember that one of the main reasons why investors turn to regulated utility stocks is for their dividend yield. In our case, however, New Jersey Resources actually has one of the lowest payout ratios among all its peers. Additionally, our analysis and extensive field research shows that the regulated arms of New Jersey Resources are limited. Additionally, looking further, on the unregulated side, New Jersey Resources has been exposing itself to high-risk, low-quality businesses as they are diversifying themselves away from a utility's core competencies. All in all, we see an overvalued utility stock here, and that is why we give our sell recommendation at its current stock price and dividend yield. With that, I'd like to turn it over to Dimitri for company overview.
Thank you, Josh. Now, at first glance, NJR might seem like a simple natural gas utilities, delivering natural gas to 490,000 customers in South Jersey. Midstream is comprised mostly of the Steckman Ridge Natural Gas Storage Facility in Pennsylvania, a joint venture with Spectra Energy. And retail is where NJR houses its solar projects. Here, revenue comes from tax incentives and the sale of SRECs. SRECs are solar renewable energy certificates, and they are generated when NJR and other companies produce solar power. Now, we expect each of NJR's business segments will face considerable challenges moving forward. On the utility side, NJR is faced with low new construction and high unemployment. Additionally, most consumers in New Jersey already have natural gas, and those who don't can't afford to convert. On the unregulated side, the commodity trading business is facing changing market fundamentals. Cheap gas in Pennsylvania is erasing most of its arbitrage opportunities. And the storage sites like Steckman Ridge make money from gas price volatility, which is unlikely moving forward. And lastly, the retail side also faces considerable headwinds. As you can see above, the price of solar is uneconomical and relies on government subsidies. And as you can see below, competitors are moving into the SREC market. As more competitors move in, the price of SRECs will decrease because of higher supply. With that in mind, I hand it over to Andre to discuss our field research.
Thank you, Dimitri. Judges, we went beyond the numbers analyzing financial statements. We conducted a randomized poll, a channel check among 59 homeowners throughout the state. And they told us that the main reason they are not moving to natural gas are the high cost of doing so. It is about $7,000. Yes, you heard that right, $7,000 on average to move from any energy source to natural gas, which is a down payment for a house in many states in the United States. We then actually interviewed somebody who knows the industry, an academic expert. And he said that it will be very hard for any of the competitors or New Jersey Resources, there are 4 companies in the state of New Jersey that do distribute natural gas, for any of them to increase their customer base will be very hard. Why? As you know, New Jersey are in the country. So people are moving out of the state and younger people are moving back with their parents. So where is the switching going to come from? We then interviewed BPU, the Board of Public Utilities, who regulates all the utilities in the state through his commissioner, Fiordaliso. Fiordaliso said that the tax incentives for solar that ended in 2016 might not be rolled over. Moreover, he hinted that those incentives might end as soon as this year. You heard that right. So most of the people that are buyers of the stock believe that the growth is going to come from solar, but really they should worry about this. We then actually interviewed the 3 competitors of the company, PSE&G, South Jersey Industry, and Elizabethtown Gas, AGL. Those 3 companies, they all share in common 2 points. First, that solar, which is such a great thing for the other company, they don't think so. They think that solar has huge costs, and they don't see it as a viable alternative to natural gas. And then the second point, they corroborated what the academic expert said. It will be very hard for them to increase the customer base, no more than 1%, which is, in the case of PSE, the PSE&G companies you might know, that's the regulated part of the company. They don't foresee an increase beyond 1%. And with this, let me turn it over to Josh.
Thank you very much, Andre. I'm going to run through some of the financial analysis for New Jersey Resources. Looking back at the fiscal year of 2010, there was a lot of uneven performance among its different business segments. Two main examples. Utility sales were down 12.6%, while energy services had actually rebounded 12.4%. Looking at gross profits, they have increased steadily over the last 3 consecutive years. They've gone from 12.7% to 13.4% to now 17.9%. However, this is still well below the peer group mean average, 25.5%. Moving on to the balance sheet, they do have a historically strong cash profile, a lot of buybacks, dividend increases. They are less leveraged than their competitors. They do also have investment-grade credit rating. However, a little bit of a red flag that's come up in the fiscal year of 2010 is that their accounts receivable has actually increased. So a lot of their customers are actually having difficulty paying their bills to them. Moving on to cash flow, we don't think a buyback is likely as the shares currently trade at a premium. Historically, New Jersey Resources has repurchased shares at an average of $36.54, right in line with our valuation model of $36. Therefore, we don't think any shares would be repurchased right now. CapEx, we expect to return to its historical $70 to $75 million range. And lastly, looking at the last chart that you have, the payout ratio over cash flow from operations, we looked at this to see how likely it would be for New Jersey Resources to be able to actually increase their dividend. As you can see, the industry average is 10%, and New Jersey Resources actually has the highest ratio, payout ratio to cash flow from operations, holding at 19%. So any future dividend increases we think are limited at best. And with that, I'd like to turn it over to Russell to go over our valuation.
Thank you very much, Josh.
Excuse me.
NJR trades at a premium since its EV to EBITDA ratio of 10.6 times is greater than that of its industry competitors. However, this premium is unjustified since NJR's EBITDA margin of 8.4% and dividend yield of 3.4% is much lower than its peer competitors. We took 3 approaches to valuing NJR. The first I'd like to discuss is PE comparable valuation, where we applied a comparable PE multiple of 15.8 times to our 2011 EPS forecast of $2.50, which led us to our PE comparable valuation of $39.55. The second valuation we did was a discounted cash flow valuation, where we valued NJR to be $32.92, which incorporated a weighted average cost of capital of 5.95% and a terminal growth rate of 2%. Finally, we did a sum of the parts valuation, where we applied a 14 times PE ratio to NJR's regulated segment and an 11 times EV/EBITDA ratio to NJR's unregulated segment, which led us to a sum of the parts valuation of $34.94. So in summary, we applied a third weight to each of our valuations, which led us to an ultimate valuation of $36 for NJR. And I'll now let Anil conclude our presentation.
Thank you, Russell. I'd like to address some risks to our recommendation, although these are well mitigated. Strong GDP growth and a strong housing recovery than we expect could increase the demand for natural gas distribution. Higher fuel oil prices could increase the likelihood that customers would transfer over to natural gas as a fuel source. A takeover by a large utility, while it's always a risk, we don't think it's possible at this valuation. However, its joint venture partner, Spectra Energy, might be a takeover competitor. Lower cost solar technology could increase their profitability in this space, although with 5,000 registered solar contractors in the state, it's already highly competitive. Recent developments support our sell recommendation. The company missed its Q1 EPS in February. The shares have recently been downgraded by Argus and Breen Murray on valuation. And in February 10th, the Star Ledger reported that New Jersey will end the subsidies for residential solar this year. With that, New Jersey has also signed its 150th residential solar lease out of a total pool of 490,000 customers. So they're not getting much customer base from that area. In summary, NJR offers low yield and limited growth prospects. We see limited regulated growth in New Jersey. Our field research suggests that solar is expensive and unsustainable. Its unregulated segments are risky and in low quality earning stream businesses. We believe that the storage facility Steckman Ridge as a midstream asset is already priced in now that it's been fully operational for a year. And our valuation reveals that it has an unjustified premium. In sum, this is an overvalued natural gas utility that's diversifying away from a utility's core competencies, and we recommend to sell. With that, we welcome your questions.